In this video, I'll be going through Work Together problem 13-4. This problem here is located on page 394 of your Century 21 Advanced Accounting Textbook, edition number 11 by Gilbertson and Lehman. So credit to them for this textbook and the problem. Okay, so first part here, we are calculating permanent and temporary differences in net income and taxable income, right? So one on our company's balance sheet, income statement, not balance sheet, and the other would be on our tax return, right? Okay, so they have net income and taxable income of $95,000 before depreciation and interest revenue. In addition, they have identified the following two items that will cause differences between net income and taxable income. So they have some office furniture that they bought, and they're going to do depreciation of straight line method for their books, but for taxable income purposes, the depreciation will be different, okay? And then the second item was some interest revenue of $2,500. So first thing we need to do is identify each difference between net income and taxable income as permanent or temporary. All right, so depreciation of office furniture. Underneath your temporary differences section, you can look at page 392, the second paragraph, and it tells us the largest temporary difference is often associated with depreciation. Right? Many companies use straight line depreciation for the calculation of net income so that the amount of depreciation is level over the life of the asset. But for that same asset, the company will usually use an accelerated method of depreciation for the calculation of expense. And that's to put against the taxable income. Okay, so this is usually a temporary difference, depreciation, right? But interest income, that's a little different, okay? So they received $2,500 for interest earned. And this one's actually going to be, if you look at permanent differences section, it would fall within that range. And you can look no further than the little diagram on page 391, and you can see taxable interest revenue right there. So that one is going to be a permanent difference. Next task, let's calculate our straight line depreciation for the office furniture. So what is our cost? We bought it for $49,000, so equals $49,000. And it says there is no salvage value, so we don't have to subtract that away. We just have to divide it by the 7-year useful life estimate. So $7,000 is our straight line depreciation. Okay, so part 3, calculate our net income. So our net income before depreciation was $95,000, right? And we'll take away our depreciation expense, which is the $7,000 we calculated here. Okay, and then we're going to add our interest revenue that we earned, because we received $2,500, okay, so that will get us our net income. So minus the depreciation plus the interest, $90,500. So taxable income before depreciation and interest. Sorry, part 4, we're going to do our taxable income now for tax purposes. So we'll start with the same $95,000 as we did on the last one. And we're going to subtract our depreciation expense. But for tax purposes, it's $12,250, remember? So, and our interest revenue, this is not a taxable amount, okay? It's tax exempt. So we're leaving it off there. So our tax revenue is $82,750. In fact, we could put all of this in currency. So you can see what those differences cause, the permanent and the temporary differences that we looked at for our income statement, that You know, we get to show the world as a part of our publicly traded company, $90,500 is what we're going to show. But for the IRS, they're going to see $82,750 on our tax return. So that is how these permanent and temporary differences can show up in your financial reporting. So that's the work together problem. This on your own is very similar. So I'm going to let you do that on your own.